Are bonds a good investment right now, or are you, like many investors, holding too much cash because the Fed raised rates so rapidly? This question has been echoing in the minds of investors recently. Let's delve a bit deeper into this. It's important to reflect back to an unusual period spanning from 2020 to 2022. This was the time when the world was grappling with the pandemic, and investors were grappling with zero interest rates. Yes, let us not forget, the zero interest rate policy, or ZIRP, was in full swing, making the returns on cash effectively zero. Not exactly the most rewarding time for cash holders, was it? However, as we moved into 2022 and 2023, things took a dramatic turn. The Fed switched gears, hiking up interest rates rapidly. This sudden shift had a significant impact on the market. Cash and short-term bonds, specifically those with a term of less than 3 years, suddenly began yielding over 5%. Now that's a yield peak that hasn't been seen in over 2 decades. You might think, well, that's fantastic for cash holders. And to some extent, you'd be right. After all, who wouldn't be thrilled with a high yield on their cash? But here's where things get interesting. While it's true that high yields are generally good news, at least in the very short run, it's crucial to consider the bigger picture. In the world of investment, what seems beneficial in the short run may not always yield long-term benefits. And that's precisely the conundrum we're facing. So we circle back to our original question. Are bonds a good investment right now? Or put another way, did that historical yield peak really benefit cash holders in the long run? As we continue to explore this topic, we'll explore deeper into these key questions, examining the potential risks and rewards of both cash and bonds. For now though, let's pause and reflect. This yield peak was historical, but did it really benefit cash holders in the long run? Indeed, it's food for thought. The losses on long-term bonds and even intermediate bonds in 2022 left many investors wary. This was a year that saw a startling correlation between declining bonds and stocks, a phenomenon that was both unusual and rare. Investors were left with a bitter taste in their mouths as they watched their portfolios shrink, all the while wondering, what happened? You see, in a typical scenario, when stocks are on the decline, bonds are expected to behave inversely. This means that they should provide a safety net, a cushion against the volatility of the stock market. However, in 2022, this theory did not hold water. Bonds, rather than acting as the safety net they were supposed to be, joined stocks in their downward spiral. Indeed, holders of long-term or total bond market indexes have seen only modest relief, and individuals' holdings and even bank balance sheets are still impaired. This unexpected turn of events left investors scratching their heads. The fear and worry that gripped investors wasn't just because of the losses they experienced. It was because the very foundation of their investment strategy was shaken. If bonds, the supposed safe haven, could behave in such a volatile manner, then what could they rely on? This fear, this worry, wasn't just about the present. It was about the future. If bonds could behave this way once, could they do it again? This unexpected turn of events changed the way investors looked at bonds. The trust, the confidence they had in bonds was replaced with caution. This caution led to a shift in strategy. Investors started holding onto their cash rather than investing it in bonds. The question that arose was, is this the right strategy? Is this caution justified? As we delve deeper into this topic, it's important to remember that while the events of 2022 were unexpected, they were also rare. Historically, bonds have provided a safety net during times of stock market volatility. They have offered investors a way to diversify their portfolios and protect their investments, at least in terms of an intermediate or short-term time frame. So, while the caution that has arisen from the events of 2022 is understandable, one must also consider the historical performance of bonds. This unexpected turn of events has left investors in a state of caution, but is this caution justified? As we move forward, we'll explore this question in more depth, looking at the potential benefits and drawbacks of holding onto cash versus investing in bonds. Stay tuned, because this journey is far from over. In 2023 and potentially into 2024, investors fell into a lull of holding too much cash. The security of holding liquid assets may seem appealing, especially when coupled with attractive yields. However, this approach may not be the most effective strategy for all types of investors. Consider this. When you're a short-term investor, having cash on hand can be a good thing. It provides a cushion against unexpected expenses and helps to weather any sudden financial storms. With the rapid rise in interest rates during this period, the yields on cash were indeed quite enticing, making it a seemingly safe harbor in a turbulent sea of market uncertainties. However, for intermediate or longer-term investors, this lull into cash holdings could pose a risk. It's like waiting at a bus stop, watching as the buses come and go, while you're waiting for the perfect one. But what if the perfect bus never comes? You could end up waiting indefinitely, missing out on the potential gains that could have been made if you had just boarded one of the earlier buses. The same applies to investments. While you're holding on to cash, waiting for the perfect moment to invest in bonds or stocks, you may miss out on profitable opportunities. It's a classic case of paralysis by analysis, or deer in the headlights frozen. By the time you decide to make a move, it could be too late, and you may have missed your chance to capitalize on the market's ups and downs. Moreover, cash, while liquid and seemingly safe, doesn't offer the same potential for growth as other forms of investment. And the erosion of inflation experienced by most in the form or higher prices seems awfully sticky and persistent now, regardless of government metrics saying otherwise. It's like planting a seed and expecting a tree to grow without ever watering it. It's unlikely to yield the desired result. So, while the safety and high yield on cash may be alluring for short-term needs, it's important to not get lulled into a false sense of security. Holding on to cash for too long could mean missing out on the potential gains from other investments. This over-reliance on cash may seem safe, but is it really the best strategy for long-term growth? It's a question worth pondering as we navigate the complex world of investing and the future scenarios of ballooning government debt, inflation, and higher prices. And if you've made it this far and enjoy wise financial insights, consider giving us a like and subscribe to support our work. We appreciate it. Despite the unusual events of 2022, research indicates that bonds do deliver meaningful diversification benefits in years of negative equity returns. Indeed, Vanguard's research reveals that bonds can be a sound investment, particularly when equity markets are bearish. It's a counterintuitive concept for many, especially given the recent history of rapid rate hikes and the lure of high cash yields. However, the research presents a compelling case. Take, for instance, the Vanguard Short-Term Bond Fund, or VCSH. This exchange-traded fund, or ETF, focuses on short-term corporate bonds, typically with maturities of about 3 years. Despite the turbulence of the past few years, this fund has consistently offered a competitive yield, providing investors with a steady income stream. Now let's consider another example, the Vanguard Intermediate Term Corporate Bond Fund. This ETF targets corporate bonds with a slightly longer maturity, typically around 7 years. It offers a higher yield than its short-term counterpart, taking advantage of the steeper part of the yield curve. Plus, it provides a greater potential for capital appreciation, giving investors a two-pronged approach to earning returns. These examples are not meant to suggest that bonds are without risk. Like any investment, they come with their own set of challenges. But the key takeaway here is that bonds, particularly corporate bonds, can offer a robust combination of income and potential capital appreciation. This can be a powerful tool for investors, particularly in a climate where equity returns may be under pressure. This is not to say that all investors should move all their cash into bonds, but it does suggest that considering a portion of cash to move into short-term or even intermediate-term bonds could be a wise and shrewd move. This could offer higher total returns, are low cost, and designed to be held for the number of years in the duration of the fund. So while the fear from 2022 is understandable, it's important to not forget the potential benefits of bond investments. The risk right now is that investors don't understand this key concept and will hold too much cash for too long. In the financial landscape, holding too much cash can seem like a safe bet, especially after the unexpected turn of events in the year 2022. The high yields on cash, thanks to rapid interest rate hikes, may indeed be alluring. However, it's crucial to remember that this is a short-term perspective. For intermediate or long-term investors, this strategy could lead to missed opportunities. When you hold onto cash, you're essentially waiting for the right moment to invest. But what if that moment is now? What if, while you're waiting, you're missing out on the potential returns that bonds can offer? Specifically, short-term or possibly intermediate-term bonds. These bonds provide an opportunity to move out on the yield curve. Instead of keeping your money in cash, you could be investing in 3-year corporate bonds, or even 7-year corporate bonds. By doing so, you're not just grabbing current higher yields for longer, but you're also diversifying your investment portfolio. Research by Vanguard indicates that, despite the unusual circumstances of 2022, bonds do indeed provide meaningful diversification benefits in years of negative equity returns. So even if the stock market takes a downturn, bonds can offer a safety net. Moreover, bonds such as the Vanguard Short-Term Corporate Bond Fund VCSH and the Vanguard Intermediate Term Corporate Bond Fund are designed to be held for the number of years in the duration of the fund. They offer higher total returns and are low cost, making them a wise investment choice. Remember, it's not just about the here and now, it's about planning for the future, considering the long term, and not letting the fear of the past dictate your financial decisions. Holding onto cash might seem safe, but it could also mean missing out on potential returns. Remember, active personal management and action now could make you wise. Don't let the fear of the past hold you back from potential gains in the future.